Hello friends, good evening to all of you, and today in this video we are going to discuss about the duration and further related to the different methods involved under the measurement and quantification of the market risk. And further we will be discussing the how we can mitigate the market risk, how we can do the back testing, and further related to the stress testing too. So kindly please confirm the audio video quality so that we could proceed. And further, if you're new to our channel, please do subscribe the channel and press the bell notification icon so that you get updated whenever we upload the new video. So the full course videos of CAIIB is available at our website iibf.info, and we are going to announce a giveaway from in tomorrow video. We will be announcing a giveaway, so be ready for the same, where we will giving away a free course to a candidate who will be answering the questions. Okay, so kindly please confirm the audio video quality, and further you can do enroll the courses visiting the website iibf.info. Hefty discount of 80%, huge discount of 80% is available. You can get that particular discount applying the coupon code LSPRO. The prices are already discounted at 75%, and over and above this 75% discount, you will be getting extra 20% off on all the listed courses applying the coupon code LSPRO. I'm going to mention the coupon code in the description over here. So the coupon you need to apply over here is LSPRO. You need to visit our website https://iibf.info, and further you can apply the coupon code over there. And if you want to join us on our WhatsApp group, for the procedure, if you want to join the WhatsApp group, the procedure is you are to write your name, mention CAIIB along with it, and WhatsApp it to the number 83609 44207, and we will be adding it to the appropriate group. Okay, so we have forwarded all the details in the SMS chat over here. You can do look over there and further can join our group. So the audio video quality over here seems to be working very fine. So let us start the session. In the previous video, we were discussing related to the duration, and we have gone through the theoretical part of the duration, and further we were covering related to the properties of duration. And now in this particular video, we'll be covering a practical problem based upon duration. So duration mathematically is equal to summation of present value into the time factor divided by the present value of the bond. Okay, so I already told you that in the case of bond, you are provided with two benefits you are having. One, it is a coupon amount that you are getting at the end of the period, and further second, it is a face value that you get at the end of the maturity. That is said to be what? That is said to be the redemption value that you're getting. Let us take the case that you are having a 3-year bond. In that particular case, if the coupon percentage is 8% and the face value mentioned over here is rupees 100, in that particular case, the person will be earning rupees 8 per year as coupon, and at the end of the 3-year term, he will be getting the face value of rupees 102, that is 100 rupees. Okay, so if you want to calculate the present value, we are to basically calculate the values of inflows at some discount. That would be basically the market yield you are getting. You will be discounting this value at the market yield you are getting. So let us have a look related to how we can calculate the duration and modify duration. The duration is also said to be Macaulay duration because it was, first of all, it was basically, the concept was given by Frederick Macaulay. That is why it is named to be Macaulay duration too. Now let us have a look at the question over here. So bank ABC held a bond with face value of rupee 100, and for the coupon rate is 8% payable yearly and maturity after 5 years. YTM, that is yield to maturity, is given to be 6%, or we can simply say rate of return over here in this case is given to be 6%, and we need to calculate the duration of the bond. I already told you there exists a inverse relationship between the YTM and the bond price. What does it mean? That if the bond price, if the YTM is greater than that of the coupon rate, in that particular case, the market value or the current market price of the bond would be lesser than that of the face value. In that case, the face value, the market value will be lesser than that of the face value. But in the opposite case, where the YTM is lesser than that of the coupon rate, in that particular case, the present value or the market value would be higher than that of the face value. That is the same case we are dealing with over here. In the case, we are provided with the coupon rate of 8% and the YTM is given to be 6%. So 6% is lesser than that of the 8%. So in this particular case, the present value that we'll be calculating would be higher than the face value, that is rupees 100. So we calculated it to be 108.42 in this particular case. That is higher than that of the face value of the bond itself. Is that clear? Okay, so we are provided with all the details over here, and we need to calculate the duration of the bond. Let me zoom into the screen, and further I'll be telling you that what particular fields you need to identify so as to calculate the duration. In the first column, you will be mentioning the frequency of the coupon so are is received. So whatever it is the frequency, in this particular case it is not provided, so we'll be say we are getting the coupon at annual frequency. It may be the case it is specifically mentioned over there in the question itself that you are getting the semi-annual coupons. You are getting the semi-annual coupons. In that particular case, it will be 0.51. So if it was mentioned to be that you're getting the semi-annual coupons, in that particular case the A column would have been 0.5, then 1, then 1.5, then 2. So it would be covered in such a manner. But in this case particularly, the question we are having right now, in this case we are having the coupons to be paid on annual basis. So it is taken as 1, 2, 3, 4, 5. That is a time period when you will be receiving the inflows or cash flows. Okay. And in the second column, it is given to be the cash flow you are receiving. The cash flow you are receiving for 1 to 4. For 1 to 4 years, you're receiving only and only the coupons. Okay. And at the end of the maturity, the person would be receiving the coupon as well as the maturity value or redemption value, that is 100 rupees. That is why it is written to be, it is clubbed to 100 plus 8, that is equal to 108. Is it clear? In the C column over here, we are having the discounting factor. How one can calculate the discounting factor? It is as simple as that you can calculate the discounting factor 1 divided by 1 plus R raised to power n. Now R is the discounting rate. R is what? R is the discounting rate over here. In this particular case, we will be considering the discounting factor to be yield to maturity, that is a 6%. So it is in decimal, it will be 1 divided by 1 plus 0.06 raised to power n. For first year, it will be equal to 1 divided by 1.06 raised to power 1. For second year, that is for the second term, it will be equal to 1 divided by 1.06 raised to power 2, and so on. Okay, so that is what we calculated. I can just let you know that how we calculated it. Okay. So in the calculator, you can see over here, if it is visible, if we calculate 1 divided by 1.06, it comes out to be 0.94. And again, when I'll be pressing equal to, it is 0.889. That is a value that we have already written over here. Then the next value, it is 0.8396. So it is rounded off to the 2 decimal part, that is 0.84. The other one, it is 0.79, and then it is 0.747 and rounded off to 0.75. Is that clear? That is how we basically calculated what? That is how we calculated the present value factor, or we can simply say it is a discount factor that we have mentioned over here. Is that clear? And in the D column, in the column number 4, we are having the we have just multiplied the B column with the C column. We have multiplied the B column with the C column. What we are doing actually, we are getting the present value of the all the cash inflows. So whatsoever cash inflows are there, we are just calculating the present value by multiplying them with the discount factor that you have calculated. So we multiplied these terms and we are getting the present value of these cash flows. So particular D column is related to what? It is related to the present value of the cash flows. It is basically the present value of the cash flow, and further we just calculated these value multiplying the B column with the C column. And further, if we aggregate, if we take the aggregate of all these terms, that would be equal to what? That would be equal to the present value of the bond. Because what happened actually, we are getting rupees 8 for 5 years. Let me draw it over here. 1, 2, 3, 4, 5. So we are getting rupee 8 for 5 years, and at the end of the 5-year tenor, we are getting the 100 rupees value too. So we are discounting it to the present value. So we are discounting this all the inflows to the present value. So this is the scenario. So multiplying this term, multiplying the inflow with the discounting factor, actually providing us a neutral point or same point, that is the present value of the bond. So we calculated the present value of these cash inflows, and further we basically added them up all, and we are left with what? We are basically have calculated over here the present value of the bond. Is that clear? So the total of the D column basically signifies it. Basically we are calculating what? We are calculating the present value of the bond over here, that is 108.42 rupees. Is that clear? and is what I said over here to you, that if YTM is lesser than that of the coupon rate, so YTM over here, that is a rate of return is 6%, which is lesser than the coupon rate of the 8%. What does it mean? It means our current market price is going to be over and above the face value. That is what we calculated, that it is greater than that of the face value of rupees 100. Is that clear? So how we calculated the coupon? So coupon is always calculated on what value? It is always calculated on the face value. So whatsoever the coupon percentage is given, it is calculated on the face value. That is how we basically calculated the cash flow of rupees 8 over here, that we are going to receive for each and every year. At the end of the maturity, we are going to receive the redemption value, that is the face value of the bond, that is rupees 100. It means in the last year at the maturity, we will be getting the coupon as well as we will be getting the face value. Okay, so these are the inflows. In column C, we calculated the present value factor. Present value factor is nothing but it is 1 divided by 1 plus R raised to power n, where n is the frequency and further R is the discounting rate, which is given to be YTM in this particular case, because we are going to discount all these factors at the yield so available. Okay, so that is what we did, and further we calculated the discounting factors. In the D column over here, we just multiplied the B column with the C column. That is, we are calculating the present value of these cash inflows. We are calculating the present value of these cash inflows, and when we will be adding up all the present value of the cash inflows, we will be basically calculating what? We'll be calculating the present value of the bond, that is 108.42. Now in the last column, that is the E column, we are multiplying the present value of these cash inflows with the time factor, that is the T over here, that we mentioned over here in the column A. So in the A column over here, we are having the T factor. We are having the T factor when you are receiving the coupons or the inflows. Okay, so that is it. That is the E column that we calculated, that is multiplying A with the D. That is how we calculated E column over here. Okay, so we are having this particular value, we are having the different values for the different rows over here, and further in the last column over here, we basically added up all these value, and we are left with what? We are left with 470.80. that is signifying what? So PV, it is a present value of the inflow, and multiplying it with the time value, multiplying it with the time factor, and adding them up all, that is the summation of all these. That is what is the value over here. And in the numerator, we were having the sigma PV. If you remember, this is a formula related. This is the mathematical representation of the duration. This is the mathematical representation of the duration that we already have covered over above. Okay, so that is a formula related to duration, and that is how we simply calculated it. I know the calculations are quite difficult, but it will not be the same single question that you will be getting in the exam itself. It will be covered in the case of the case study. Whether it would be covered in the case form of a case study where we will be getting 3 questions or 5 questions. Okay. So it is worth solving it. So it is worth learning this particular concept, because it is going to come in the form of the case study, or it may be the case that you are already provided with all the values and you just need to find out the answer. That is how you can do calculate. Okay. So the duration over here, it will be equal to 470.80 divided by sigma PV, that is 108.42. So it will be simply equal to 470.8 divided by the 108.42, and it is equal to 4.34. so the maximum duration, or simply we can say the duration, is equal to 4.342. It is 4.342, and it's always in years. The duration we calculate, it is always in years. Is it clear? That is how we calculated the duration. What are the different factors over here we calculated, and further how it was possible so as to calculate the present value and all the other terms related to it. You must be crystal clear with the things, that what values you are getting, what are the inflows, and further that how do you calculate the coupon, and where you need to consider the YTM. So YTM is considered when you are calculating the present value factor, or we can simply say discounting factor. When you are calculating, you are using the discounting rate, it is as the YTM it is to be mentioned. It may be the case in the question it is mentioned rate of return. It may be the case it is mentioned over there in the question itself, the required required rate of return. So whatsoever the second percentage mentioned in the question, other than that of the coupon rate, it is basically considered to be as what rate? It is to be considered as the required rate of return in particular these type of questions, but that certainly depends upon the wording of the question itself. Okay. So that is how we calculated it. Then simply we multiplied the B with C, and in the last column we multiplied the A with D, and we further we take a sum of all these terms that we calculated, and further there we solved the duration formula itself, and there come the answer related to duration, that is 4.342 years. Now what is related to the modified duration, that if we were to calculate the modified duration too, how we could be able to calculate? So how can we calculate the modified duration? So the formula was quite simple. It is equal to duration divided by 1 plus R. I already told you R over here is not the discount rate. It is equal to YTM divided by N. That is the frequency of receiving the coupons. Okay. In this particular case, you are receiving the coupons yearly. So N will be equal to 1. Okay. And R will be equal to YTM itself. Okay. So it will be equal to 4.34 divided by 1 plus R. That is YTM is given to be 6%. So it will be 0.06 divided by N, that is equal to 1. That is how we can calculate it. So it will be equal to 4.34 divided by 1.06, and that is the modified duration. That is equal to 4.096. It is the modified duration that you calculated over here. That is 4.096. Is that clear? Okay, what if you were receiving the coupons semi-annually? What if you were receiving the coupons semi-annually? Just let me give an example related to it. I'm not going to solve the full question based upon the semi-annual coupons, but I'm going to give an idea that what values would be covered over here. So in the column A over here, the first value would be 0.5, and over here the cash flow, we need to half the coupon rate also. The coupon rate would be 8% divided by 2, that is equal to 4%. So if it is 4% half yearly, you'll be getting the coupon ₹4 half yearly. In the third value over here, the present value factor that we calculated as 1 divided by 1 plus R raised to power N over here, if you remember. Okay, that is the discounting factor. Now in this particular case, in the previous case, we calculated it as to be 6%, but now it will be half to that would be 6 divided by 2, that is equal to 3%. So it will be calculated as 1 divided by 1.03%. 1 divided by 1.03%, that is 1 divided by 1.03 raised to power 1. That is how we can calculate it. The discounting factor, that is 1 divided by 1.03, that is equal to 0.97. That is equal to 0.97. And in the fourth column, you need to multiply these. That is into 4, and that is how we calculated it to be 3.88. And further in the last column, you need to multiply the 3.88 multiplied by 0.5, because we need to multiply it with the first column over here. So it will be 1.94. So you are going to repeat this exercise for all the terms. In this particular case, it would be not the 5 terms, it would be equal to 10 terms, because if it is paid half yearly, in that particular case there will be 10 terms when you will be getting the inflows. Okay, so all the terms are to be covered in that particular case. Is that clear? Is that particular part clear? That is how we can solve it in the case of if the coupon is being paid half yearly basis. Okay, and that is how we calculated the duration, and further we calculated the modified duration. Then it is related to what? It is related to the bond price changes can be estimated using the modified duration. So if there is a change in the bond price, and further if there is change in yield, we can calculate the percentage changes in the price itself. So let us take the case that the previous YTM is given to be 6%. Let us take the case that the YTM changed to be 6.5%. The return changed to 6.5%. Now in this particular case, what would be the approximate percentage change in price? What would be the approximate percentage change in the price? It would be equal to what? It would be equal to modified duration that we calculated as 4.094 or 6, and multiplied by the yield change. Now the yield change is 6.5 minus 6%, so it will be 0.5%. So that is how we can calculate. That is 4.094 into 0.5. That is 4.094 multiplied by 0.5. That is equal to what? That is equal to, there will be 2.047 percentage change in the price itself. Okay, so the percentage change in the price will be 2.047%. Is that clear? That is how we can estimate the percentage change in pricing using the modified duration. Okay. Next, it is equal to the downside potential. Next is it is equal to the downside potential. So we have already gone through the downside potential, and further we also have calculated it using the VAR, that is a value at risk. So in the case of the downside potential, we are basically combining three concepts. Those are related to sensitivity, volatility, and third it was related to the probability, that is the uncertainty of the effect itself. Okay, so further the risk materializes only and only when the earnings deviate adversely. So whenever we were considering the volatility, in particular case of volatility, where it was also the upside and also the downside, but in the case of the downside potential, we are going to focus only and only at the adverse effect of it. Okay, so downside potential only captures the possible losses, so it is a comprehensive method so as to calculate the risk factor over here, and further it ignores the profit potential. Okay, so it is a comprehensive measure of the risk, and further it integrates what? It integrates the sensitivity, and second is the volatility, and third is it is a uncertainty that is related to the probability of the events over there. Okay, and so this is a measure that is most relied upon by the banking and financial service industry also, and also by the regulators. And we can do calculate the downside potential using the VAR, and further for calculating the VAR there are different techniques. We have previously calculated the VAR using the correlation method, but VAR is defined as what? It is defined as the predicted worst case loss at a specific confidence level. And if it is mentioned to be that a value at risk is mentioned to be, so let me give you an example related to it. We have already covered it, but let us have a discussion related to it again. Okay, so bank is having a 1-day VAR of rupees 10 crore with 99% confidence level. So bank is having what? Bank is having 1-day VAR of rupees 10 crore with 99% confidence level, and further confidence interval is given to be what? Given to be 99%. And further it meant to say what? It basically we can basically infer from this statement that out of 100 chances, only and only 1% chances are there that under the normal conditions, your daily loss would basically be increasing other than the rupees 10 crore. So if 1-day VAR is given to be 10 crore with 99% confidence level, it means that in the normal scenarios, not under the abnormal cases, but under the normal situations, under the normal conditions, if you're having the 100 chances, there will be only one single chance that your loss can be over and above rupees 10 crore for the 1-day VAR. Is that clear? Okay, and further when the duration increases, the VAR also increases. So when you the time horizon you are basically considering that increases, the VAR also increases. So VAR measures the potential loss in the market value. It measures what? It measures a potential loss in the market value, but under the normal conditions, and it does not take into effect the abnormal conditions. Okay, so rare events are not taken into the picture itself. Okay, and further it uses the estimated volatility correlations, that how prices move in relation to each other. So that is how we basically calculated it. If you remember, we multiplied the Z score. When we calculated using the correlation method, we multiplied the Z score with the standard deviation, if you remember. So in the case of the standard deviation, that was related to the correlation matrix now, where we calculated the average mean difference from the of all the terms, squared the difference between these them, that is a variance. Further we took the square root of that, and that is equal to the standard deviation mathematically. And further for longer time horizons, more would be the VAR. So if the time horizon is given to be 1 day, it would be different, and if the time horizon is a 30 day, definitely it would be greater than that of the 1 day. Is that clear? Then it is related to yield versus price volatility. Now yield volatility is basically related to what? It is related to degree of variance in yield. Now what is yield? Actually, that the amount that you're going to have having a return on the bond itself, on the securities itself. So that is yield. And yield volatility is related to what? that let us take the case when the yield was previously 6% and now it is 5.9%. So there is basically variation in the yield. There is basically variation in the yield itself, and this is largely unaffected by the time and duration. Time and duration never had a effect on the yield as such, and if it rises as yield falls. So the yield volatility rises when yield falls. So if the there is a fall in the yield, in that particular case the yield volatility will rise. Then second one, it is related to the price volatility. It is related to price volatility, that is the degree of variance in price. Degree of variance in price, that how the prices are varying, and this is largely unaffected by the yield and substantially affected by the time and duration. That is related to the price volatility, and the formula for the price volatility is yield volatility multiplied the basis point value multiplied by the yield and divided by the price. So that is what? That is the price volatility. Is that clear? So the formula for the same, you need to note it down, that is equal to yield volatility multiplied by the BPV multiplied by the yield and divided by the price. And as I already told you that there are different approaches so as to calculate the value at risk, that is the VAR. The three approaches are the correlation method, historical method, Monte Carlo method. Okay, and the correlation method is also named as variance matrix method or covariance matrix method. And further, the other two are historical simulation, and the third one, it is a Monte Carlo simulation. Is that clear? So on the first unit of the module B, we calculated the VAR using the correlation method, that is a Z value into the standard deviation. So all three methods are based upon three basic parameters. What are those three basic parameters? First of all, it was related to the holding period or based upon the number of observation days. So when we calculated the VAR for 1 day, or whether we calculated the VAR for 10 days, so that is basically related to what? That is related to the holding period. Second, it is related to the confidence interval. So if we are going to having a confidence interval of 99%, that is related to the certainty or uncertainty. Okay, and further it is related to when we calculated the confidence level to be 99% or 95%. So for all these different confidence percentage, there is a different value Z value. And further, historical time horizons over which the assets prices are observed. Asset prices are observed. So that is related to the third factor for which we calculate the VAR in all the three approaches. Okay, so three approaches having the important basic parameters. One, it is related to the holding period. Second, it is related to the confidence level, and third one, it is related to the historical time horizon over which the asset prices are observed. So in the case of the historical simulation particularly, what actually we do, we actually have the previous historical value data, and further using those patterns we try to correlate those data that is related to it. And also in the case of the correlation method, we basically correlate the differences between the two methods, okay, between the two prices. So whether we are having the mean average squared differences, or we are having the past related data, or in the case of the simulation data where we are having a new set of variables which are set as per the expertise of the tester itself. In that particular case, we basically, in all the cases, we use what? We basically use some time of data, that is a time horizon data, along with which the calculations are being made. So let us have a look further related to these methods where we can understand this particular thing pretty well. So first case, it is related to the correlation method. First, it is related to what? It is related to the correlation method. The change in the value of the position is calculated by combining the sensitivity of each company to the price changes in the underlying asset. Okay, so if you remember, we were having the correlation. Now you basically did what? We were having the dispersion factor over here. That is a volatility over here, and we basically calculated what? We calculated the average price differences, average mean differences of these values from the mean value, and further scared the differences, and further that was the variance. So basically we did what? We basically did calculated the sensitivity of each component of with the price changes of the underlying asset. Okay, so that is a with the variance, and further we basically had the variance over here, and further we basically combined all the three factors. That is the sensitivity, that why how one factor is being changed with the percentage change, that was related to the sensitivity. Second, it was related to the volatility, that we calculated by way of the variance metrics. And the third one, it is related to the uncertainty, that we basically did with the use of the Z table itself. So it is a deterministic approach. So it is also termed as what? It is termed as a deterministic approach. So VAR can be easily calculated using this method, Z score multiplied by the standard deviation. Second approach that we are having for calculation of the VAR, it is a historical simulation approach. So using this approach, we calculate the change in value of a position using the actual historical movements, on the underlying assets. Let us take the case, we were having a past data of the bond. And further based upon this past data of the bond, we are making the calculations. We are going to calculate the risks. Okay, so depending upon the different scenarios, let us take the case where we have taken a window of 30 days. We are basically selected a window for 30 days, that the past data of 30 days was selected, and based upon that past data of 30 days, we are going to match this particular data with the current market value, of the bond over here, and we are going to simulate it. So we are going to simulate it, that whatever the changes over there, whatever the market conditions over there, and based upon that, we are going to find out a relation between them, and then we are going to calculate the value at risk. So that is basically related to what? That is related to that you are having the different values in the historical data, you are having the different value in today's scenario, you are basically correlating these particular values in present scenario with the past data, and further inferring the value at risk from there. So that is related to that. Okay, and in the case of the historical simulation approach, the length of the historical period so chosen does impact the results. Because if you basically have chosen a shorter length period, let us take the case in the historical simulation approach. I just selected the data for 4 days. Or I was not having a accurate or appropriate data related to that particular security. So I selected only 3 or 4 days. Okay, 3 or 4 days data. Now in this particular case, it may be the case that the proper events, that all the events that occurred in the history are not captured under this particular window of 4 days. Okay, so in that case, that would be all in vain. So historical simulation approach will not be giving me the required results. Okay, and also if I just take a very large length, if a large length was selected, let us take case, I just selected the data for the 360 days. In that case, it will also be covering the stale positions in the market itself. Okay, because it may be the case that there were reputations and all the things, so it would be too stale to predict the future if the window so chosen was quite large. If the window so chosen for the historical simulation was quite large. Is that clear? So the advantage of this method is that it does not require the user to meet any explicit assumptions, whether in the contrary to that of the Monte Carlo simulation that we will be learning in the very next step. In this case particularly, in the case of the historical simulation approach, the user who is going to predict the VAR, who is going to predict the future returns or risks over there, he needs not to explicitly or express any of the assumptions from himself. Okay, so he should not be having any kind of the expertise or anything related to that. He just needs to select the data from the history, and further he will be correlating this data with the present scenarios, and further we can work on it. Okay, so we are not going to make any kind of the assumption this particular is about the correlations, about the dynamics of the risk related to that. Okay, then the third one, it is a Monte Carlo simulation method. So Monte Carlo simulation method calculates the change in the value of the portfolio using a sample of randomly generated price scenario. So you basically are having provided with a sample of randomly generated price scenarios. So you are having the different price scenarios. let us take the case you randomly generated a price scenario where there were different price scenarios under the different conditions, where there were the different prices under the different conditions. That were the assumptions that you have made. So it was a random prices. Let us take the case the price was 91, then it was a 94, then it was a 96 or 102. So these are the randomly generated prices. Now based upon this random pattern, the user will be making some assumptions. So user is to make some certain assumptions related to the market structure, related to the risk factor, and further they are to correlate between the risk factors and the volatility of these factors. That what are the market factors that would be there and what would be the correlation with these factors. The user must be having some expertise related to it so as to make assumptions. And further, it depends upon basically what it depends upon the mentality. So whatsoever the user is going to predict using the Monte Carlo simulation method, it depends upon the person's expertise or person's level of accuracy, that how did he just selected the different data, how he just did collect he just correlated the different risk factors along with the volatility of these factors, and he just calculated the VAR. Okay, so he's essentially imposing his views and experience. Okay, in the case of the historical simulation approach, the user's approach and views were not imposed, but in this case particularly it is being done. So that we can say that is a disadvantage related to it. So you must be having an expertise, you must be known about the market scenarios, what are the volatility factors of those market risk factors. So each and everything must be crystal clear to you. So if you are going to use the Monte Carlo simulation method. Now, on the whole, we calculated the VAR, and further, what are the advantages of VAR? Let us have a look at that. Okay, so it is it is a good tool for all the banks, financial institutions, multinationals, fund managers for protection of the customer, because we are basically provided with the value at risk that we are having. So if I say I'm having 100 rupees VAR, the daily volatility is rupees 100 at 99% of the confidence interval. At 99% confidence interval, it means that the daily volatility of 99% of the chances that I will be facing a risk. I may be imposed with a risk of rupees 100, but only 1% chances would be there under the normal circumstances that the losses will go beyond rupees 100. Isn't it so clear, crystal clear picture that you're having right now? Okay, so it basically translates what? It translates portfolio exposures into potential profit and loss. So what would be the potential profit or what would be the potential loss? It basically translates portfolio exposures to the same, and further aggregates and reports multi-product, multi-market exposures into one number. So if you're having the multiple products, if you're having the multiple market exposures, you can have a one number related to it, that what would be my portfolio risk, and further what are the potential profits and what are the potential losses basically associated with the same. Then meets external risk management disclosures and expectations. So as per the regulators also, this is the current best practice, and further it is a very vital component that must be followed, and further it meets the external risk management disclosure and expectations, and it is embraced by the practitioners, regulators, and academics. And what is the limitation of VAR? So we just looked at the bright sector, but there is a dull side also, that is basically related to the limitations. So it does not measure the losses under the abnormal market conditions. Whenever we studied the definition of the VR, we have each and every time we basically reiterated that it is related to the normal market conditions only and not for the abnormal market conditions. So VAR itself is not self-sufficient for risk management purposes. So you cannot totally rely upon it, because there are abnormal conditions. It may be the case that they may happen there, they may be having a probability of 1% or 2%, but definitely that can happen. Whether it was a case of the GFC, global financial crisis, whether it was something other scenario, there can be economic slowdown, there can be other scenarios where you can face the higher risks than prescribed by the VAR method itself. And measures to get over this limitation include what? It includes a back testing and model calibration and scenario analysis and the stress testing. So different scenarios are there, different so these limitations which are imposed by the VAR, those can be basically calibrated using the back testing and stress testing, and for the model calibration and the scenario analysis. Is that clear? So what is the role of VAR in control and monitoring? What is the role of VAR in control and monitoring? So VAR is used as MIS, that is a management information system tool. So it is used as MIS tool in the trading portfolio. So if you're trading and further you are having a portfolio, so different securities are there which you are basically have invested your money into, and further if you look at the each and every product, that what is a VAR for each and every product. So let us take the case, I am having the different products P1, P2, P3 and P3. P4, and further for each of the product I'll be calculating the VAR. I'll be calculating what? I will be calculating the VAR. So on the whole, I can just locate that what would be my average value at risk. What is my average value at risk? So that is related to it, and further as per that I can do set the limits. I can do set my risk limits, that what is my appetite, what I can do absorb, what I can take risk into. Okay, so if I say that the VAR is 5,000 rupees and the daily volatility is for 1 day is given to be 5,000 with a 95% of the accuracy for okay, in that particular case, if I do have an appetite for taking a risk of rupees 5,000, even with the 99% of the accuracy, and that case also I'll be basically undertaking the transaction. Otherwise I'll just leave the transaction if I'm not having the appetite so as to digest, so as to absorb the 5,000 of the risk. In that particular case I'll not be undertaking the transaction. Is that clear? So VAR is used for making the decisions for the businesses, so what to do and what not to do. Okay, and further it is related to VAR is useful MIS tool that has to be back tested by comparing the day's VAR with accrual and necessary re-examination of the assumptions. So whenever you are using the VAR, it is not like the case that you have just calculated the VAR for today and you are just free from all the tensions. It is not the case. You're going to use a back testing, that you're going to see that what were your assumptions and what risk you faced, and further you're going to re-examine it. If you basically, I just said under the VAR that the probable loss would be 5,000 rupees, and let us take the case that I faced a loss of 5,600 in the single day with a 1 day volatility. I faced a risk of 5,600. No, there was a 1% probable chance, but I'll just re-examine it. I'll just look into it, that what different assumptions I could take and could make my decision much better than this particular case. Okay, so I'll be just re-looking at it, and that is related to what? That is related to the back testing. And further, it is used to measure and manage the market risk in the trading portfolio and the investment portfolio. Is that clear? So we can do measure the risk and we can do manage the risk using the VAR. After that, it is related to estimating the volatility. Estimating the volatility. So VAR uses past data to compute the volatility. So in the case of the VAR, we use the past data so as to compute the volatility. So basically we are correlating today's data, present scenario data, with the past data so as to calculate the volatility. And one is arithmetic moving average from historical time series data, that we are having some historical data, and further based upon that we are correlating with it today, and further we are moving arithmetically. And the other one, it is a exponential moving. In exponential moving average method, the volatility estimates rise faster to the shocks and it declines gradually. So if there was some shock, let us take the case in the previous scenario, you were having some shock value where there was a steep cut in your profits. In that particular case, for those cases, the volatility will be estimated very high or exponentially. It will be estimated exponentially, and then gradually it will decrease, Is that clear? So we basically can estimate the volatility using the VAR, and further VAR uses the past data, and in the case of the arithmetic movement, the movement of the volatility is as such along the volatility as estimated in the previous data. And when you are using the exponential moving, in that particular case, if there was a shock, so as to such the shock conditions over there will be a steep increase in the estimation of the volatility, and further it will decrease gradually. Is that clear? So different banks take the different number of days for estimating the volatility, and volatility also does not capture the unexpected events as the case of the VAR. So in the case of the volatility, estimating the volatility or VAR, we do not capture the unexpected events or the abnormal events. So all these things complicate the estimation of the volatility. So it should be combined with the stress testing it must be combined with the stress testing, and stress testing takes into account the worst case scenario. So in the case of the stress testing, we basically try to do what? We take into account the abnormal events only, because in the case of the VAR, the only limitation that was there, that is related to that, it does not take into account the abnormal situations. So that can be resolved by using it with the stress testing. Then further, based upon the previous 60 days data, based upon the previous 60 days trading data, the information is available. So volatility per day is given to be 3%, assuming it's 252 days in India. Calculate the value at risk for 10 days at 99% confidence level. At a 99% confidence level for investments of rupees 10,000. For investments of rupees 10,000, we need to calculate what? We need to calculate the VAR, that value at risk. So let me just tell you the formula to VAR is related to, it is equal to Z score into standard deviation. Z score into standard deviation, and the daily volatility is given to be 3%. So if you remember that how we solved the question in the first unit of module B, so daily volatility is given to be 3%, and that is equal to what? That is equal to 3% of 80,000. So the total investing amount is 80,000. So 3% of the same. So it is 80,000 multiplied by 3%, that is equal to 2,400. So daily volatility is 2,400. And if we need to calculate the standard deviation, if we need to calculate the standard deviation over a period of 10 days, that would be equal to what? That would be equal to daily volatility. That would be equal to daily volatility. And further, we will be multiplying it with the under root of the time horizon. So time horizon value was, it is given to be 10 days, because we need to calculate the VAR for 10 days. So it will be equal to 10. So it will be equal to 10 under root and multiplying it with 2,400. So it is equal to what? So it is equal to 7589. So it is equal to 7589.46. Okay, so the volatility for 10-day period. So the volatility for the 10-day period is equal to 7589.46. Is that clear? Because the volatility is associated with that, it is the standard deviation itself. Mathematically, we can say it is the standard deviation itself, so we can do easily calculate it. Okay, that is how we just calculate it. And what would be the VAR? So VAR, for calculating the VAR, it is to be calculated at 99% confidence level. At 99% confidence level, and I already told you that you need to memorize what? You need to memorize the 99% Z value, that was equal to basically Z into SD, that is 7589. So 7589.46, we need to multiply it with the Z value, and we can do locate the Z value. I'm just showing it from the Z table itself. In the Z table itself, you can locate it over here under the factor 2.33, 2.34. That is equal to what? That is equal to the 99%. So I'm just having the value over here. That is equal to 2.34. Okay, if you locate it over here, it is not 2.34, it is 2.33, not 2.34, because it would be equal to 99.04. Just let me mark the value over here. So it is this one value. So decimal value over here is 0 0.00, 0 0.01, 0 0.02 and 0.03. So it is a 2.33. So the value over here is a 2.33. So 2.33, and simply multiplying it with the 7589. So it comes out to be 17683.45. So what does it infer? It infers that if you are going to invest rupees 80,000, or if you have already invested rupees 80,000, and the daily volatility is given to be 3%, and in that case, if you are having the 99% confidence level, the maximum loss you can face in 99% of the cases, it will be up to 17,683.45 rupees. But in normal conditions also, there would be 1% chances. There would be 1% chances that your loss can go beyond this particular figure that we calculated. Is that clear? So it is not considering what? It is not considering the abnormal conditions. It is not considering the abnormal conditions over here. Okay, so that is related to the question 1 over here. Second question over here, it is also related to the same. It is also related to the VAR. So based on the previous 60 days trading data, the following information is given to us. And further, volatility per day is 2%. Volatility per day is a 2%, assuming 252 days in an year. And further, we need to calculate the VAR for 15 days at a 95% confidence level. So if the daily volatility is given to be 2%, so it is equal to 2% of what? It is equal to 2% of 60,000. So that is equal to what? That is equal to 1200 rupees. That is equal to 1200 rupees. And further, we need to calculate the daily, we need to calculate the volatility or standard deviation for how many days? For 15 days. Okay, so that would be equal to daily volatility, that is 1200 multiplied by under root of 15, multiplied by under root of 15, that is it. So because we need to calculate it for 15 days, so 15 under root multiplied by 1200, so that is equal to what? 15 under root multiplied by 1200, that is equal to, there is some issue with the calculator, I think. Multiplied by, no sorry, there was some issue. 15 under root multiplied by 1200, that is equal to 4647.58. Is that clear? 4647.58. And further, if we need to calculate the VAR, now this is not at 99% risk, it is at not at 99% confidence level, it is for 95% confidence level. It is for 95% confidence level. So we will be looking at the value from the chart over here, that would be equal to 0.95. So now over here, if we look at the factor for these value, we are having 0.95 over here. This would be the value. So it is equal to 0, 1, 2, 3, 4, 5. So it is equal to 1.65. It is equal to 1.65 over here. This is the 0.05 value that we were calculating over here, and it is said to be 1.65. In this particular case, it is equal to 1.65. So Z value is 1.65 multiplied by 4647.58. So that is equal to what? That is equal to 7668. 7668.50. That is how we can calculate the value at risk. Is that clear? Okay, and this value that we are calculating, this is using what formula? This is using what method? What approach? We are using the correlation approach. We are using the correlation approach. Then it is related to the back testing. So back testing is what? It is a process. What is back testing? That whatever the value we have selected or assumed, we are basically assuming a value, that we are having a loss of this particular value using the VAR. And further, there would be the actual result or practical results, we can say. There will be the practical results. Now, we will be re-examining it with the assumption values. We will be re-examining it with the assumption values. And further, it would be, further we will be calculating it. So there was a error they are saying related to the value that we calculated. No, sir, it is not 1.96. It is with the 95% confidence level. It is 1.65 only. It is 1.65 only. Kindly please look into the Z table carefully. So it is 1.65 only. Okay. Is that clear? So basically, in the case of the back testing, we do what? We basically, it is a process where we based upon some model, we calculated, we assumed the VAR based upon some model, based upon some assumption, based upon some approach. We calculated the VAR, whether it was a correlation method, whether it was historical simulation or the Monte Carlo simulation. We calculated VAR and further we applied it, and further we are having some present results. We are going to backtest our assumptions if those were accurate or not. So backtesting for evaluating a new model requires comparison with the actual performance on a continuous basis for a given period. So you are basically comparing the actual performance with the simulated performance. So one, it is a simulated performance that you simulated using the model. So there is a model that we created. Model means some technique that we created using which we are calculating the VAR. Using which we are calculating the VAR. So now this is a model performance and this must be the actual performance, and there must be some differences between these two. So it will not be the same case now, that whatever value you are having, you are basically getting the same value, because the market is so much unpredictable, and further there are different scenarios could be there. So in that particular case, we basically evaluate a new model. In that particular case, if we want to evaluate a new model, we need to compare the actual performance on a continuous basis. Is that clear? Assessment of accuracy of an existing model needs back test on a regular basis. So if you want to check the accuracy of that particular model, particular technique that we created over here, we need to back test it with the actual performance. Is that clear? And that must be done on regular basis. One should observe whether the trading results fall within the pre-specified confidence bands as predicted by the VAR model or not. Okay, so if we just predicted by using the VAR model that our losses would range from 0 to 17,000. Let us take the case for the 99% or 95% confidence level. We basically predicted that our losses will not go beyond 17,000 for 95% of the cases. There are 5% cases that our losses will go beyond 17,000. Okay, but still, if our value is falling in between the predictable period, then we can say our value is predictable as per the model technique that we created over here. And further, if the model so created is performing poorly, so it is not the case that we are just getting the value for one day and we are saying our model is not working properly. We'll be basically analyzing the actual performance for a couple of days, and further based on that data we can say if our model is working poorly or not. Okay, so if our model is working poorly, is performing poorly, and further there must be some further probe. We must further have a further probe into it, that what were the different assumptions that we have not kept in mind, or it may be something wrong that we have calculated so far. Okay, so we must be looking into it, and that is related to what? That is related to the back testing. And further, BIS has outlined the back testing best practices in January 1996, and they published a document related to that. What is related to? It is related to supervisory framework for the use of back testing. So the market participants must be using the back testing so as to whatever the methodology they are using. So whatsoever the methodology they are using, so as to get a market scenario, so as to have the best practices, so as to measure and quantify and manage the market risk. There must be some standards, there must be some practices, those must be followed in conjunction with the internal model approach to market risk capital requirements, because basic purpose is to do what? Basically we must be having some capital so as to basically for that market risk particularly. So that was the main purpose now, because we are imposed with market risk. So if we are not able to measure the market risk, how it would be possible so as to maintain a capital for that particular risk that we are imposed with? Okay, so that is the main reason. So there were the BIS outlines for best back testing practices. Okay, then next one, it is related to the stress testing. But that particular topic we will be covering in the next video tomorrow. I hope that you must have liked the video and must have learned the concept from this particular video. So if you loved this video and further like the contents of video, do not forget to hit the like button, and further share this among your friends and colleagues who have been preparing for CAIIB 22, and also rate this video out of 10. Do rate it right now, because it really motivates me that how I must be preparing my video and how I'm doing well or not. Okay, so kindly please do confirm, do rate this video, do like this video and share this video. And further, tomorrow there will be a giveaway from our side. So we will be asking you some simple questions from the BFM itself, and you need to answer all those questions. And one of you will be getting the free test series for the BFM itself. Okay, so do watch video tomorrow, and further we'll be having a giveaway for tomorrow. I'll be just discussing the terms and conditions related to it, that how can you do participate. So be connected to us, and further you can get the full course videos visiting our website iibf.info. There will be the full course videos plus the case study videos plus the chapter wise questions, mock test, and further you'll be getting the access to the ePDF notes through our Android application, and that is just more than sufficient for clearing the CAIIB exam. So do enroll right now. We are having the 75% winter off, and over and above that 75% discount, you will getting extra 20% off using the coupon code LSPRO. So do apply the coupon code LSPRO, and the total discount would be equal to 80% on on all the listed courses. So do enroll right now. And further you can also join our WhatsApp group. You have to WhatsApp us writing your name and mention CAIIB along with it, and WhatsApp it to the number 83609 and we will be adding you to the appropriate group. So that would be all related to this particular video. Thank you so much, and see you again in the next video tomorrow at the same time, 7 p.m. in the evening.